most sensitive sectors are not showing evidence of acceleration. The levels, John, are way too high. We know this. But if you're trying to find a silver lining, which is hard to do in this report, that's the one I would focus on.
I think a lot of people were hoping that we'd see more of that, and that we'd go into this November Fed meeting and we'd lay the groundwork to have a downshift in rate hikes from 75 to 50, perhaps to 25. Tom, how do you think this changes that news conference with Chairman Powell in early November now?
Yeah, the downshift, if there was a probability it would happen in November, is off the table. And the next conversation, I think, for the Fed will be, are we going 75 again in December? The downshift, John, to your point, just keeps getting pushed out. General consensus, it will happen at one point, right? And that's an easy thing to say. The further you get away from, or the higher you get from an estimated neutral rate.
You brought up a really good point, and it's how much work we've already done. The temptation on a morning like this morning, Tom, and you know it well, you see a number like that, you sort of run away with yourself and you're like, they should go 100, 125, 150. Let's just wait and pause and think about what we've done already. 6 months, 300 basis points of tightening. Mortgage costs have more than doubled. I think the mortgage rate's got a 7 handle now in America, Tom. We've seen what's happened to financial conditions. We've seen what's happened to the US dollar. Can you tell me about the way you think about long variable lags in policy? All of that tightening in the pipeline already. When does that start to hit?
Yeah. The U.S. economy, John, has different lags, to your point. Investors and the Fed will focus on very short interest rate cycles, like the real estate market. As you mentioned, that market is getting hammered. Unaffordability is 07 all over again, and mortgage applications is the lowest we've ever seen. So desired effects are happening there. The reason folks will now focus on margins is that's a longer interest rate cycle. And that should be the next shoe that drops. Unfortunately, once you start to really pressure margins, that's when layoff activity starts to follow. I think this progress is just taking a little bit longer than we thought. The resiliency of the economy is there. Now, the question, John, you said this really nicely. When was the last time we saw a 2-year Treasury rate at 450?
Yeah.
For a long-term investor, these type of yields are wildly attractive because we're already seeing the desired effects of slowing growth. You can't slow growth forever. Eventually, that will mean something for inflation.
Well, Tom, let's talk about opportunity then. You look through the curve, 2s out to 30s. We can have a chat about duration. Then we can look out to credit risk, think about maybe IG, perhaps even dabbling in high yield. I mean, you can tell me. Where do you see the opportunities right now?
The screaming opportunity to me is in core, boring, traditionally unsexy fixed income, things like investment grade and municipal bonds. John, over the last 20, 25 years, the S&P 500 has annualized you about 6.5%, 7%. We can find those current yields in fixed income, less risk. So I think that's the screaming opportunity here. We are of the mindset that a recession in America is more likely than not next year. And I don't see that fully priced in the equity market. I don't see it fully priced in extended credit. So finding dislocation opportunities is our next best idea. And then monetizing volatility through structured notes. You can get downside protection and still get double-digit coupons. These are relatively defensive ways to aggregate wealth.
Tom, at the moment, I think that a lot of people like you are experiencing two different conversations with clients. One right now is the fog of war with inflation, what the Fed's going to do, where Fed funds peaks, and whether inflation comes down, and what should I do, like right now, with a time horizon of 5 minutes and maybe out to 6 months. Tom, the other conversation I'm hearing more of is whether this period is just an aberration, and we go back to the playbook of pre-pandemic, low rates, low inflation, low growth by tech. You're going to see duration kick in again, yields go back down to, say, at 1 handle, maybe 2. Tom, have you given thought about the long-term story, the destination here? Is this just an aberration, or is this a real regime change, a breakaway, a permanent break from the last 10 years?
No, I don't think it's a permanent break, Jonathan. There are, of course, going to be things that are different, and I think we have to, the most obvious one is we have to question how much confidence we can have in 2% inflation. But the longer run drivers of why interest rates have come down don't appear to have changed to me. And they're the ones we talk about all the time. Aging demographics, technological advancement, the globalized connection. That deglobalization theme is getting a lot of attention. But any onshoring that happens to America is most likely to come in automation. And is that in the tech column, or is that in the deglobalization in the higher inflation conversation? So I do think rates, all else equal, are wildly high here, and over 3, 6, 12-month horizons need to come down. So I think that's the opportunity set for a long-term investor.
A final question then, and it's a short-term one, I guess. It's about 12 months away. I asked this question of Jim Kerr, Tom. I'd love your assessment of it. The upside risk to the terminal rate of the Fed, just how much upside risk is there now, given how much we've already priced in?
I think 5% after this morning is probably where the market will settle today of what terminal Fed funds will be. Upside, downside to that is, I think will be warranted a true assessment after Q3 earnings. If earnings margins don't contract, Jonathan, we could easily reset that to 550. But if earnings and margins reset in a substantial way, we might have downside risk to that 5% number. So I guess a different way to answer your question is I think we're symmetric on those risks of terminal relative to 475, 5%, which is what's in the price.
So, Tom, if we've priced that and maybe we've more fully priced the Fed hiking cycle, how much have we priced the damage that will do to earnings?
Yeah, I think that's the piece that's missing, Jonathan. We're all focusing on what equity strategists are saying for earnings going forward, but that's just a number on a piece of paper. I think all of us have reset our earnings estimates somewhere to around, on the S&P 500, 200, 210. And now how much pain does the Fed have to inflict is whether that number should really be for 2023 earnings 180 or is 210 really likely? When we run our scenarios, Jonathan, downside risk to equities from here, it should be more limited. At 3,200, 3,300, you're pricing in a meaningful recession, a full-fledged recession. So that's going to be the awkward part, I think, for investors, at least in my community, of if we're not even seeing the recession, but the market has fully priced it, how do I match my investing know-how with my behavioral experience?
Hey, Tom, what a tough moment. Thomas Kennedy at JP Morgan. Tom, happy to share this morning with you. 60 minutes after another historic print for U.S. inflation. A lot of stocks on the move. Equities down by 2%. BlackRock is down by about 3.8%. Down in Washington, I'm pleased to say, it's Bloomberg Sonali Basak. Sonali, you and I are going to talk about this one, and then we're going to have a busy morning tomorrow morning talking about Wall Street.
We sure are, John. We're going to talk about BlackRock first because those assets have gone below $8 trillion. That is less than what Wall Street was expecting. Earnings per share came in higher than expected here, but again, there are a lot of jitters in the market about what a falling market would mean for a firm like BlackRock. Now, fixed income flows were still healthy, but you did have equities under pressure, the retail business under pressure, and certain parts of the institutional business under pressure, but not as much as the retail business. Now, to your point, if you fast forward to tomorrow, the big asset management arms of the banks are not what we normally zero right in on, but it is another source of pressure that they'll have to contend with, mostly due to falling markets, lower fees, and their clients under pressure.
Sonali, looking forward to the conversation on Wall Street this morning. Pretty much every bank under the sun before the opening bell. Sonali Basak down in Washington will be all over that in the next 12 hours. Coming up on this program, a hot inflation surprise ramping up the pressure on the White House.
I don't think there will be a recession. If it is, it'll be a very slight recession. That is, we'll move down slightly.
The National Economic Council Director, Brian Deese, joining us next. Live from New York City for our audience worldwide on TV and radio, White House National Economic Council Director Brian Deese joins us right now. Brian, fantastic to catch up with you, sir. Core CPI in America, 40-year high. This is the last inflation report before the midterms. Does the White House take any responsibility for this or whatsoever?
Well, look, it's clear that inflation is a challenge. It is a global challenge affecting countries around the world. And I think the first and most important point to make is that the United States is in a better position than virtually any other country to address this challenge and do what is necessary to bring prices down without having to give up all of the economic gains that we have made. That continues to be our focus, and that will continue to be our focus until we get this job done.
The challenge is getting bigger. The president acknowledged this week the potential for a very slight recession. His words, his assessment. You briefed the president this week, Brian. Have your internal forecasts become more or less negative over the last few months?
Well, I think it's important to look at this monthly data in context. We are seeing some progress. If you look at annualized headline inflation over the last 3 months, it was about 2%. That's down from 11% in the prior quarter. Now, a lot of that is the significant reduction in energy prices and in gas prices at the pump. Obviously, economists tend to strip those out and look at core, but for typical American families, for workers, the reduction in gas prices by more than $1 a gallon in most places in the country is a meaningful and real sign of progress. At the same time, we're seeing some elements of a transition which we anticipated, but now focus on the work ahead. Shelter inflation represented more than half of core inflation for the last couple of months. And obviously, that's a place where we're going to have to look very carefully because there is a well-known understanding that that data operates with a lag, and we're seeing some contemporaneous real-time evidence of sharp deceleration in rental price appreciation, sharp deceleration in home price appreciation. So that's going to be an area that we're going to have to stay very focused on here in the days and months
Brian,
ahead.
can you see why people get really frustrated with politicians? 12 months ago, 6 months ago, you would have said strip out gasoline and look at what's happening elsewhere. And now it's leave gasoline in because gasoline is coming down. Brian, can you see why people are very frustrated with the way the White House has navigated this issue?
No, look, I'd take issue with that characterization.
Why?
We always say that we look at the data, because we always say that we look at the data in the aggregate, and there's a reason to look in the fullness of overall inflation, and then also to look at elements of the core, like I just said. For typical American families, gas and food are big parts of their typical budget, and food prices in this report and in prior reports are moving up too fast, and that's something that we need to make more. We need to make more progress on. So we look at all of the data and understand the point about gas prices is just a very salient one. Your outlet, various others over the course of the spring spent a lot of time focused on the increase in gas prices and the impact that has on the economy, on consumer sentiment. Now that they're coming down, it's important to recognize that that has an impact on the economy as well.
Well, more recently, they've been going back up, as well you know. It's why you've been very critical of Saudi Arabia over the last week. The president talked about consequences for Saudi Arabia. Brian, what consequences? What are they?
Well, I'm not going to get ahead of the president, and as he said, he will make those decisions and make those announcements when he is prepared to do so. I think our focus right now is on continuing to make that progress. If you look nationally right now, gas prices are still down about $1.10, $1.20 from their highs this summer. We're seeing some welcome moderation in certain areas of the country, the Midwest and California now, and we still face this historically large gap between the wholesale price that energy companies pay for refined products, gas, diesel, otherwise, and the retail price that consumers are paying. So that's a continued area of focus. Obviously, refinery and refinery capacity is an element of that, but that's one of many areas that we are working with the industry and trying to focus on what we can do from a practical perspective, from a policy perspective, to try to move the ball forward.
On OPEC Plus, the NSC spokesperson John Kirby called the decision short-sighted, a short-sighted decision that benefited Russia. Can you understand why using the SPR as the strategic midterm reserve is a short-sighted decision that only leaves this country even more exposed to the whims of OPEC Plus next year?
No, look, I disagree. We said that the OPEC decision was short-sighted precisely because the lack of supply and reliable supply continues to be the dominant challenge globally in energy markets. The lack of supply continues to be the dominant risk. And the use of the Strategic Petroleum Reserve in a historic but calibrated way starting last winter was designed to address that problem and to help have additional supply on the market during this transition and during a period where we knew Russian supply was coming off and U.S. producers were ramping up. That's why if you talk to most energy market analysts, they will point to the fact that that use of the Strategic Petroleum Reserve as a bridge as U.S. producers brought production back online, was one of the principal reasons that kept oil prices from moving up even more quickly over the course of the summer and into the fall. That's a prudent use of the asset as a transition as U.S. producers ramp up.
You say it's a prudent use of the asset. Other people are very worried about this. You've drained the SPR to its lowest level in 4 decades. There's some accusation that you're putting the polls before America's energy security. Brian, the Saudis themselves said this morning that the U.S. requested a 1-month delay to the OPEC Plus output. I wonder why that would be. Brian, can you tell me whether you did ask the Saudis for a 1-month delay to that decision? Are they telling the truth?
Look, we clearly communicated our views to OPEC members that we thought it was short-sighted for them to take the action that they were contemplating, and they announced. With respect to the Strategic Petroleum Reserve, this was a calibrated decision to address the real issues in the market. We talked to U.S. industry last winter. We identified that there was about a 1 million barrel a day gap between what they were producing this winter and what they said that they could get production to by late this fall. That 1 million barrel gap was what we calibrated to make the decision on the use of the Strategic Petroleum Reserve. And people should feel confident that the Strategic Petroleum Reserve continues to be an asset that we can deploy to address our economic and national security needs. That's always what has dictated the President's decision-making on this, and that's what will dictate his decision-making on this going forward.
Brian, you didn't answer the question, so I'm going to ask it again. I'm going to share with you and share with our audience the quote from the Saudis this morning. The government of the Kingdom of Saudi Arabia would like to clarify that based on its belief in the importance of dialogue and exchange of views with its allies and partners outside of OPEC Plus regarding the situation in the oil markets, the government of the Kingdom clarified through its continuous consultation with the US administration that all economic analyses indicate that postponing the OPEC Plus decision for a month, according to what has been suggested, would have had negative economic consequences. Brian, again, it's a really straight question. Did you ask the Saudis to delay that decision for a month? Are they telling the truth or not?
Look, I'm not going to get on air and disclose private conversations that members of our administration
the Saudis have shared it with us. You've got the opportunity to say it's true or not. Is it true or not?
What I will say clearly is that the communications that we've had with OPEC members and continuing have been based on our assessment of the economic circumstances of supply and demand in global oil markets. We disagree with the assessment in that statement that it was economically the right or necessary or appropriate thing to do to reduce production at a time where the lack of global supply on the market continues to be the predominant challenge in global energy markets. That has been and continues to be the motivation behind all of our engagements internationally.
Again, they're suggesting it's a political one, that your strategy is political, that your effort
I understand what they're suggesting, and what I'm saying to you is that our strategy, I understand what they are suggesting, and what I'm saying to you is that our strategy has always been grounded in an assessment of the economics of the situation and what is prudent for the global economy, for U.S. economy and U.S. families. So
the way you would have some kind of viable energy policy from here is to make the decision as to whether what we're experiencing right now is a one-off shock or something more permanent, a one-off winter or something more permanent, a permanent shift away from Russian energy. Brian, which one is it?
We're in a transition where we face some very immediate challenges, but absolutely energy markets globally and in the United States are going to go through a transition. We're never going to go back to the pre-pandemic or the pre-Putin invasion paradigm on energy policy, and that's frankly why even as we have worked to address very immediate term issues, including helping the Europeans increase their reserves of natural gas going into this winter to try to address those immediate challenges, we have been focused on long-term prudent energy policy and providing incentives for U.S. producers of cleaner sources of energy to produce at scale and at speed that they've never done so before, and to do so in lower cost ways here in the United States so that we can be a reliable supplier of clean, low-cost electricity to our industry, to our own consumers and families, and to the world. The United States, the Biden administration have focused on that. We prioritize that, and in fact, we have now legislated long-term incentives to drive exactly that kind of investment in the United States, and that's based on an understanding that we are going to continue to be in a historic energy transition, not just in the months ahead, but in the years ahead as well.
Brian, if this is not a one-off shock, if this is a permanent shift, Can we complete the conversation by you telling me how it's a viable strategy, a sustainable approach to drain the SPR to a 4-decade low? If it's not about politics, why is that viable? Why is that strategy sustainable?
Appreciate the question. It's a mischaracterization of how we use the Strategic Petroleum Reserve. We announced a policy that was explicitly designed as a temporary bridge over the course of months, 180 million barrels, to bridge a temporary situation while U.S. producers were ramping up supply in the short term. Our long-term challenges around energy are about investing in increasing the supply of clean energy in the United States and globally at massive scale. Those require different policy tools, which is why we've enacted historic incentives, $370 billion in long-term incentives to increase investment in the United States. That's the right long-term policy solution. We can take short-term and temporary measures that are prudent and well-calibrated alongside long-term measures. That's what we've been doing.
Brian Deese, we appreciate your time this morning, sir. We really do. Thank you very much for choosing Bloomberg TV and Bloomberg Radio to have this conversation. Brian Deese there, the National Economic Council Director, following U.S. inflation, core inflation coming in at a 40-year high. Here's the trading diary for you. The next couple of days ahead going into the weekend. President Biden discussing infrastructure from LA at 2:15 Eastern time. Then on Friday, the big banks reporting earnings with the results from JP Morgan, Morgan Stanley, Citi, Wells Fargo, all coming ahead of the opening bell. We get U.S. retail sales, UMich Consumer Sentiment Survey, and finally, more from the Fed with George, Cook and Waller all on the agenda. Inflation coming in hot in America. Equities down and down hard, off by 1.3% on the S&P. The Nasdaq down by 2 percentage points. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, October 13th. Here are the top market stories that we're following for you at this hour. No, it's your fault. UK's Kwasi Kwarteng scapegoats BOE's Andrew Bailey with less than 24 hours to go until the central bank ends support. Kwarteng stands firm on his mini budget and says he's not going anywhere. And, oh yeah, it's still hot. The core U.S. inflation hitting a 40-year high, putting the Fed on track for a 75 basis point hike in November. U.S. stocks tumble, yields jump. Big fish, big money. Volatility, liquidity, recession risk. We're going to get the take from the C-suite with the CEO of Frankel Templeton as well as the CEO of PGIM. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Well, it looks like we hadn't priced out the Fed pivot based on that hot inflation data, Guy.
No, the pivot seems like a little bit further away, doesn't it? My head is spinning. I'm talking of pivoting. You've got the UK story on one hand, which basically forced yields lower. Then you get the CPI print, which forces yields sharply higher. The anomaly is obviously the UK 30-year, but we'll park that for a moment. But yeah, the bond market's got whiplash today. I think the pivot is up, down, up, down. It's volatility, isn't it? That's the narrative here. But I think underlying it all is we don't have a handle on inflation yet. And as a result of which, a pivot feels like a long way away at this point. I just wonder, was that a 75 basis point number, or was that actually a 100 basis point number? Well, we'll wait and see. I think that's a question we need to kick around. John was talking to Brian Deese just a moment ago. This is an administration that I think is really going to struggle with this number. So he's the White House director of the National Economic Council. He spoke about this inflation number. Let's get his take.
It's clear that inflation is a challenge. It is a global challenge. We are seeing some progress. If you look at annualized headline inflation over the last 3 months, it was about 2%. That's down from 11% in the prior quarter. Now, a lot of that is the significant reduction in energy prices and in gas prices at the pump.
The administration clearly will try and put a positive spin on this number. And if you twist the numbers, you can probably take a positive spin away from the fact that broadly inflation, maybe you could argue, is coming down, but it's into the services sector, and that is really very sticky. Mike McKee, our international economics and policy correspondent, joins us now to give us a take on this. Mike, that was a hot number, wasn't it? Is there any way to spin this positively?
Not really. In a nerdy sense, Guy, you could say the Fed knows, the administration knows that it's going to take a long time to bring inflation down, and that's certainly been the talk here at the IMF meetings, that it's going to take until sometime next year before we see significant progress against inflation. But we really didn't see much at all in the month of September. We saw the core rate rise at the same rate as last time, and the headline rise at a much stronger pace, and that suggests going forward that we're still going to have an inflation problem. I mean, the Fed is looking at the month-over-month numbers rather than the year-over-year numbers. They want to see some sequential declines, and they're not getting it at this point. The one good piece of news is that we did see goods prices level out. They have been going up. We've been waiting for that switch to services. Services up, goods prices up, but not by as much, and so maybe that's a sign that something is going to be happening in the future, but not enough to make the markets happy today.
So, Mike, the market repricing was extreme. We got Barclays now seeing a 75 bip hike for November and December. The swaps market was pricing in a terminal rate of near 5% by March of 2023. What is the reaction, that we're going to see a higher terminal rate for longer, or that we get there faster, or both?
Well, possibly both, but the second part, keeping it there longer, is probably where the Fed is going to place its emphasis. They had already been talking about 4.5 to 4.75% as a terminal rate, and maybe they move that up. The markets had expected a final move in March. Maybe that comes forward, but their idea is that once you get up to a certain rate, you leave it there for, they're thinking, a year at least, maybe longer, until inflation is really clearly whipped, and that's not been happening. So I think the narrative remains the same from the Fed. A guy does get the award today, the Little Black Cloud Award, for being the first person in all of the messages I've gotten from analysts to mention the idea of a 100 basis point move. So yeah, you've now put it on the table, Guy.
Well, you know, Guy's good like that. But he's in the UK. There's like the doom and gloom there. You can see why he'd go for the 100 bips. Mike, thanks a lot. Really appreciate it. Bloomberg's Michael McKee. All right, let's get more market reaction here to the U.S. CPI data. Ethan Devitt, Montana Chief Investment Officer, joins us now. Ethan, what can you still do to re-rate for a Fed that's going to be going harder, faster, maybe for longer?
Well, what I'm very reassured by is that the Fed is very much aware of nuance. We're all focused on the headline number, but if you read a recent speech by Lael Brainerd just this week, you can see that they're actually very much looking under the hood. They're looking at how the transmission of their tightening is having an effect on different sectors. For example, they're looking at the retail sector, at the housing sector. That may be an area that already we're seeing the effect of these mortgage rates that have essentially doubled over the course of a year. So they want to see inflation coming down across the board. They want to see where it's happening first, and we can see it's already starting to happen. There will be a lag in how it happens later, and they understand that, and markets have to understand that.
I appreciate that there is evidence that we are seeing inflation moderating in some really important areas. The problem with that, even, is that we are now also seeing it pick up in other areas, namely the service sector, where it is more sticky and more problematic and more difficult to get rid of. Isn't that the sort of mission we're looking at right now, the transition, sorry, we're looking at right now, from kind of goods inflation into services inflation, and that could be longer lasting?
And we do, of course, have to break open, again, service inflation, what's actually in there. Health insurance is in there, say the price of airline tickets, the cost of going to a restaurant. And what makes up services? Well, goods feed into services, goods and labor. Of course, labor takes up an increasingly large part of services. So if goods are moderating, that will eventually have a transmission effect in services. And the key thing there is labor. Will labor moderate? And clearly we've seen there is no sense of that slackening the demand for labor. We can see that the participation rate is still lower, but at the margin we're starting to see a little softening there. That gives me reassurance, the fact that labor is not weaker, because I would like to see the consumer supported. I'd like to see consumers able to get a job if they want to seek one. However, clearly a real pressure on the price of labor will continue to keep service costs high. But I also suggest that if something like health insurance is comprising a lot of those service costs, is that going to be a one-time jump or going to be consistently rising in the double digits every year? I don't think so.
Ethan, if everyone had to protect their portfolio against really high inflation 8 months ago, do you need to protect your portfolio against an overactive or overachieving Fed? And if you do, where's the safest place to be?
Well, we published a piece, Shelter from the Storm, because it is very hard to take shelter anywhere today. Even the areas that were supposed to be inflation resilient, such as real estate, real assets, say even energy, renewable energy, they've all taken a hit recently. REITs have fallen by almost more than the mainstream index. Clearly, the equity effect of REITs has dominated their real estate components. We therefore recommend having a purer form of real estate and real asset exposure, where the income from that should be CPI linked. That's a way of building an inflation hedging. Of course, while the Fed is still active like this, we can expect to see bond markets and equity markets move in sync. That's bad news for the balanced portfolio. That's why we recommend our clients do have a piece in alternatives that are not marked to market in the same way. But unfortunately, while the Fed has its role, very little that can be done to hide.
Ethan, okay, let's just talk about that lower need to mark to market in the alternative sector. What I'm learning out of the UK right now is that illiquidity can get very ugly very quickly. And if you are if you're investing into lower liquidity assets, that can be a double-edged sword. What do you say to people that have that concern about liquidity, of going into alternatives for that absence of mark to market, but ultimately that could come back and bite them fairly quickly if that whole space dries up? You can't get out at that point, or it is certainly more difficult to get out.
Absolutely great analogy. We're speaking about, the key areas where you do have crashes and these kind of massive dislocations always stems from illiquidity. It stems from leverage. It stems from concentration. Those three factors have never changed. I think the big surprise in the UK right now, and why it's kind of a petri dish for what might happen around the world, is illiquidity emerging in a sector that should have been 100% liquid, always had been liquid, was expected to be low risk, so long-dated government bonds. That's been the surprise. In the case of mainstream alternatives, which are supposed to be illiquid in the sense of private equity, private credit, hedge funds, or those interval funds which have quarterly liquidity, no client should enter those funds without being highly aware of the liquidity constraints, and furthermore, not expecting something that is quarterly liquidity to actually be liquid if there is a liquidity crunch event. That's why allocations to this area have to be ring-fenced, they have to be limited, and you should never see this area as your ATM or your source of liquidity. I don't think that has changed. I think, if anything, the education factor has really improved, as well as these products actually being better aligned with their underlying assets. So there isn't even the mismatch that we used to see with, say, listed private equity. So I actually think if an investor is forced to have a fire sale of their illiquid assets, that is a disaster. There's no other word for it. We would hope no investor ends up in that circumstance. Of course, with this negative surprise in the UK around so-called liquid assets, anything is, of course, now possible.
Absolutely. Read the fine prints. Ethan, great stuff. Thank you very much indeed. Ethan Devitt, Monitor CIO, thank you very much. Coming up, we're going to discuss financial instability in the UK and the impact that it can have on the ECB. We're going to speak to Governor Šimkus, Lithuania's central bank governor, and ECB Governing Council member. That is coming up next. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
Peak Fed, peak hawkishness. We're getting carried away.
The market's been right.
Are rate hikes starting to pay off?
How long is it going to take to see progress on inflation?
Fed just has a long way to go.
Instant reaction on Bloomberg Surveillance.
Inflation is still sticky. The U.S. economy is still on track.
And what it means for the Fed.
The data will tell us.
I think we're quite a ways away from a pause.
This is a Fed that will blink. The prudent thing to do is to ease off a little bit and just have a look around.
Inflation in focus today on Bloomberg.
So the pound is up, gilts have surged. This on reports that the UK officials are working on a U-turn of the tax cuts proposed by the UK Prime Minister Liz Truss and her Chancellor Kwasi Kwarteng. Kwasi Kwarteng says he's sticking around and he's trying to avoid questions on whether or not we are going to see some sort of a reversal. But the point here is basically we have seen potential financial instability having an impact on monetary policy. And that is the question that I think a lot of people are asking about central banks in Europe right now. Will financial instability prevent central banks in Europe from dealing with the inflation that is bubbling up pretty much everywhere right now? Gediminas Šimkus is the Lithuanian central bank governor. He is, of course, an ECB governing council member as well, and joins us now. Sir, thank you very much indeed for your time today. We have so much to discuss. But let me start with financial instability. How worried are you regarding financial instability right now, and whether or not problems in financial markets will prevent the ECB from being able to bring inflation back down to target? How big a threat is that to your inflation target?
So financial instability, or I would like to put it differently, financial stability is very important, because only in stable and efficient financial markets that are not fragmented, we can effectively transmit monetary policy signals. I see the financial instability, so no, I don't see that the financial markets in the euro area would be unstable now. And, there are various measures that need to be monitored and assessed in order to say the market is fragmented or unstable. So at the moment, I don't think this is the case.
But, Gediminas, hello, it's Alex in New York. Is this something that the ECB is talking about, particularly when it comes to fragmentation and Italy, for example, and widening spreads there? As in, can you tighten financial conditions and maintain financial stability? The UK proved that that was not possible.
Well, what regards the UK case, I think we can draw several lessons here. First, that the prudent policies matters, that the short-term spending, I mean, you can do something with short-term spending, but if you go with a permanent increase in budget spending or lower revenues, you need to find credible ways how you finance this. And second, that the coordination between the monetary policy and fiscal policies matters. What regards the euro area, I would say that we did a good job, because we created and we have two preemptive tools that would allow us timely and efficiently address the fragmentation in the euro area market. This is the PEPR investment, and this is the transmission protection instrument, so-called TPI, that are very powerful, I would say, instruments. They don't need to be used now, but if something happens, they are at our disposal to be used. And secondly, and the final thing I here would like... Yeah, please.
Sorry, carry on.
Okay, and the final thing is that we need to, if we want to, so the thing that we need to address, this is not the increase in spreads or increase in yields, but this is the unwarranted, unjustified by economic fundamentals changes in the price of the financial market instruments. So that's also a very important thing to note here.
Monetary policy within the Eurozone and its transmission to the economy relies on the banking sector. Governor, there was a report out earlier on today suggesting that the Governing Council is close to changing the TLTRO rules, TLTRO rules, and that the plan was, and I'm quoting here, to hurt the banks. Governor, is the ECB Governing Council discussing changing the TLTRO rules, and if so, how close are we to such an announcement?
Well, in our monetary policy toolbox, we do have not one, but several measures, and TLTRO definitely is one of those. What we see that the financial situation in the markets, economic situation has changed, and as we Keynes once said, when facts change, we need to change our mind. And I think this economic environment, the monetary policy case clearly shows us that there is a need to discuss the TLTRO requirements.
Are you discussing it now, and what would be your recommendation?
Well, I think my opinion is that we need to discuss in the coming monetary policy meeting at the Governing Council. So we need to have a discussion on this.
Are the banks not doing? Are the banks not behaving appropriately at this point in terms of the way that they're lending to the real economy?
Sorry, can you repeat the question? I didn't hear it.
Is the financial sector, is the banking sector not behaving appropriately in the way that the banking sector is lending to the real economy?
What do you mean by this?
Well, are the banks doing what you? Are the banks doing what you? That monetary policy is transmitted in the eurozone via the banking sector. What is the problem that you see at the moment with the way that the banking sector is operating?
Well, I wouldn't say that we do see a problem now in the banking sector. One thing I would like to know here that we live in a very, so to say, uncertain environment. So lending requires additional cautiousness because we experience various types of shocks: inflation shock, financial tightening situation. We do have energy price shock. We do have war in Ukraine that also adds additional pressure to the global economy through supply side shocks. So the cautiousness, that's what's needed. But I wouldn't go, in a way that somehow, to blame the banks what regards the monetary policy tightening, normalization.
Okay, Governor, just one final quick question. A couple of weeks ago, you were asked your preference in terms of whether or not the next move should be 50 or 75 basis points. Given the data we've had since then, are you moving in the direction of 75, or are you still considering a 50 basis point hike at the next meeting?
No, I would say that at this moment, seeing the latest inflation figures for euro area, seeing the broadening inflation, maybe headline inflation is somewhere around the corner, but core inflation is also raising its head, it's intensifying, it's broadening. So I would say 75 now is something what we need to do in October. What's 75 or 50 in December, we need to discuss and see on the basis of data we're going to have in December. But so far we're still far away from the natural interest rate. It's kind of clear at this moment.
Governor Šimkus, it's a great pleasure to speak with you. Thank you very much indeed for sharing some of your time with us today. We really appreciate it, really illuminating as to what is happening within the ECB. Thank you, sir, very much indeed. Lithuania's central bank governor and, of course, a member of the Governing Council of the ECB. Now, earlier today, I spoke with the Ukrainian Energy Minister, Herman Halushenko, on the latest Russian attacks and the impact that they are having on critical Ukrainian energy infrastructure.
In fact, that is the biggest attack on energy infrastructure from the old days, from the past days of war. And just the approximate figure, so they hit something around 30% of all energy infrastructure of the country.
It's having a major impact on Kyiv, of course, these air raids, and on the infrastructure that is vital to keeping the city running. The mayor of Kyiv is Vitaly Klitschko. He joins us now. Mr. Mayor, thank you very much indeed for your time. We just heard from the Energy Minister talking about the impact that the air attacks have been having on critical infrastructure. Can you just update us on what is happening in Kyiv right now and how you're coping with those attacks and the outages that we're seeing as a result?
Good afternoon, everyone. It's in Kyiv, situation under control right now. 3 days ago, we have massive rockets attack in capital of Ukraine. I tell that the Kyiv always, the capital of Ukraine was target and still target of Russian aggressors. And this attack was to infrastructure object and middle of the city, historical center, where unguilty people is the Russians told about special operation against military forces, and right now they attack the center of the Kyiv University, Red University, where is a lot of students, where is no military forces. They try to make it panic and depression the people. Instead, them the people very angry and ready to defend. Also defend our hometown. Also, the part of the attack was critical infrastructure of our city. They want to destroy the electricity, want to destroy the heating system before the winter. I call it genocide because the main wishes to bring the whole country in chaos, and it's not the special operation, it's genocide of Ukrainian population, because from critical infrastructure depend the lives of millions of people in our hometown.
Vitaly, hi, it's Alex in New York. Can you give me a sense of how you may be preparing for winter, since you brought that up, since energy infrastructure is so vulnerable right now? How are you preparing for the next 6 months?
We actually depend from government, because government promising the electricity responsible for that and gas energy. We prepare and calculate many scenarios, also in worst case scenario, and that's why we try to be prepared for any situation what can happen in our hometown, but also in worst case, and that's why we give the information to our citizens what they need actually, but what depends from the city, we prepare the points where the people take the food, medication, or warm condition from the government, from the city.
Mayor Klitschko, are people staying in the city or are people leaving? Before the war, the population of our city was almost 4 million people. Right now, 3 million people live in the Kyiv, and some part of the people are left, but majority coming back. And actually, last 2 months we doesn't have some attack in our hometown. It's almost a peaceful situation. The restaurants and cafes open, but last for 2 days, it was really one of the biggest attacks to capital of Ukraine.
So to that point, things are very then far from anything resembling normal, like restaurants being open. Are we seeing the other side? Is there panic buying or things like that starting to emerge after last weekend?
Yes, of course, the safety today is main priority for everyone in Ukraine, and also for citizens in our hometown. We prepare the bunkers for the people. We give the instruction what they have to doing, and every day, couple of times a day, we listen the warning sirens. It means everyone have to go immediately to much safety place and spend there some period of time. Actually, right now the people yes, of course, everyone is scary, and but we doesn't have panic, and like before, people understand we have to live in some critical conditions. But we don't want to leave. It's our homes. It's our homes. It's our city.
Mayor Klitschko, this is a very delicate question to ask, but Vladimir Putin has talked about the use of nuclear weapons. Are there any preparations underway for such an eventuality?
My personal opinion, it's big bluff. Putin used nuclear weapons. It's the part of Russia received the all air mass go to the east, and it's mean the Russian can be also involved so much. The population in Russia will be involved in radiation. First point. Second point, we actually have experience in Ukraine with Chernobyl catastrophe. We know what is it, and main point, we already tried to be afraid. They explain about worse things what happens in Ukraine. Yes, of course, nobody wants escalation, but we doesn't have another choice. We have to defend our homeland, and if Putin talk about nuclear weapons, it's show his weaknesses, because Russia's army not successful in the east or south of Ukraine. They lose a big part of territory, and right now Putin try to bring the new agenda in the game, talking about nuclear weapons.
Mayor, last question. In the West, there's been a lot of talk about how to provide Putin any kind of off-ramp. Is an off-ramp right now in Ukraine a non-starter or a starter?
Putin talking some right now, the last time talking, let's find a compromise, let's find a solution. Yeah, I don't know what about talking Putin, because it's not compromise to give up the big part of territory. And yesterday, United Nations decide actually what did the Russian Federation is illegal. I mean, to take the part of Ukrainian territory. And what I have to say about it.
I think you actually just said a lot of it. Thank you so much. We do appreciate your time with us. Thank you very much, Vitaly Klitschko, the mayor of Kyiv. Thank you very much. So, Guy, I feel like that pause and that silence said a lot. We may like to talk a lot about an off-ramp and how to do it, but on the ground, and the reality is, we don't see that happening. So if that's the case, that conflict continuing to be very long in the tooth, how do you manage that from a political leader perspective?
The off-ramp is that Russia leaves Ukraine. I guess that is the off-ramp the Ukrainians are looking for. And I think a number of European politicians have made that clear over the last few days as well. Does that happen voluntarily? I don't know. Clearly, we are seeing significant gains territorially being generated by Ukrainian forces. But ultimately, is that going to create a bigger response from the Russians? We've certainly seen the bombing over the last few days in response to the attack. We think it was an attack. We don't know it was an attack on the bridge in Crimea. That's the risk here, that as Vladimir Putin is pushed further back, he retaliates even more aggressively. Plenty to think about, but the off-ramp would seem to be fairly straightforward. Leave Ukraine. Right. We're an hour into US trading. That is very much dominated by the CPI report. Abigail Doolittle tracking all the action.
Hey, Guy. Well, yes, it is a bit of a bearish day because of that hotter than expected CPI. But at this point, we're well off the lows. At the lows, the S&P 500 down more than 2%. The NASDAQ 100 down more than 3%. At this point, the S&P 500 down 1.1%. It had been down just about 0.7% not so long ago. So it's going to be interesting to see how this day plays out as the NASDAQ 100 also comes off its lows down about 1.8%. Now, as yields shoot higher, that, of course, means the Bloomberg Dollar Index is higher, but not so much. It's up 0.3%. That VIX higher, but again, not so much. So it's going to be interesting to see whether or not this 7-day losing streak, if it somehow reverses into the end of the day. One reason to think, while there is so much attention going to the slight miss and the fact that core is hotter than expected, take a look at this chart in the Bloomberg terminal, because CPI, inflation itself, is coming down. Everybody a few months ago asking whether or not we had seen peak inflation. This chart might suggest that, yes, we do have inflation down down 0.9% from its peak. Unless it starts to rise again, it does suggest that could be the case. But as we have that higher core, we do, of course, have these bond yields soaring as bond traders scramble to catch up with where the Fed may be going. That 2-year yield right now, right around 4.5% off of its highs, but still it is higher and to some degree suggesting where the Fed funds rate is going to go, and some saying that it's going to go to 4.85. In fact, that's what the markets were saying. And then finally, one interesting spot, Alex, we have the banks higher, up about 0.7%, probably with yields ahead of earnings. BlackRock, though, not participating, down about 2%. They did, of course, have a little bit of a rough earnings report, especially in terms of assets lost. This rough trading action really taking a bite out of BlackRock's assets, down more than $500 billion, Alex.
All right, Abigail, thanks a lot. Great setup for us. Abigail Doolittle joining us on the markets. So that's a perfect setup for our next two guests. So we get this really hot inflation number. We already are seeing earnings coming out with a mixed kind of bag here. We're having stocks move lower, rates jump higher. So joining us for an exclusive interview, Jenny Johnson, Franklin Templeton President and CEO, and David Hunt, PGIM President and CEO. It is so great to see you both. Thank you for joining us.
Great to be here, Alex.
Great to be here.
So let's start macro, which I'm sure you guys are both excited about. So David, from where you sit, how high and how fast is the Fed going to have to go? And then what breaks from your desk?
So I think what we've really seen is that finally the message that the Fed's trying to send is getting through. The market has been hoping against all experience that somehow we would have a soft landing, they wouldn't have to hike as fast, they might be able to come down next year. And I think what's now really clear is that they are going to hike as fast, they are going to get inflation down, and that the U.S. economy is actually in very good shape, which strangely, of course, is bad news because it means that the Fed is going to have to do even more. So I think the volatility you're seeing now is kind of a begrudging acceptance by the market that we are now entering a new regime. We're entering a regime of higher inflation, higher rates, and one probably ultimately that leads to a recession and lower growth. And that's a very different situation than we've been over the last 5 years.
So Jenny, I know that you guys are obviously very long-term investors, but a new regime change, and you said 5 years, let's go 12 years. I mean, let's go 14 years. It's a very different world than that. And this can affect those investments for the next 10, 20 years. How do you think about it?
Well, I mean, I agree with David. I think that there was one view that inflation was transitory. It was really because of the events that happened, and we were talking about energy and food. But now we're seeing core inflation. You're seeing rents go up. It's very, very sticky. But the consumer's still strong. Delinquencies and credit cards are very low. In the core inflationary, people are still going out and going to restaurants. So the consumer is still healthy and spending. And I think, we are probably in a longer-term inflationary period for a period of time. The Fed has to get aggressive. They're afraid of what happened in the 70s by stopping raising too quickly. I think probably everybody after seeing this number is not only expecting the 75 maybe in November and the 50 after, but starting to look into 2023 and saying there'll be some additional hikes there as well.
So this is a question for both of you. What do you guys think breaks? What is the potential breakage, and where does that come from? And you can look at the UK and what's happened there, and I appreciate that some of that is the fiscal package, but that was just the light of the fire. The tinderbox was already lit. Jenny, where is the potential for something to break?
So I think you have to, quality companies, this is why value is back into favor. Quality companies with good cash flow, good strong balance sheets that can withstand this. Anybody who has a lot of leverage, we're going to start to see some real pain with that. I think if you're investing, one of the things that we remember in bear markets is that dividends account for about 40% of total return in equities, and it's a great time to buy good dividend type stocks and quality.
David, what about you? What breaks?
So what's really different now is that we actually have fiscal policy moving in exactly the opposite direction as monetary policy. So over the last couple of years, we've actually had 10% of GDP around the world pumped into the economy by governments. They borrowed to do that. At the same time, we have central banks around the world raising rates at a level that's actually quite unprecedented. These are now working in opposite directions. And the UK is probably the best example example of that, but it's happening in other countries around the world. And what I think we can draw from this situation is that one of the places to look is to really be careful about liquidity during periods like this, particularly where that liquidity has to do with government debt, which has grown with such an enormous propensity over the last couple of years.
Jenny, good morning. It's Guy in London. I've been living through this over the last few days as we've watched what should have been a very liquid 30-year gilt.
You would think.
Becoming very illiquid, yeah. Jenny, you've been talking a lot recently about alternatives and maybe going into private markets. Is the worry now, though, that those are the areas where we could see illiquidity really becoming a major problem? And do you think investors understand the illiquidity risk of some of those assets?
Well, I think, again, a lot of those vehicles in private markets are actually permanent capital vehicles, so they don't have that same kind of stress. I think what we saw in the UK was really where you had leverage and you were having margin calls, and immediately you go to your liquid assets to be able to cover your margin calls, and that puts folks, I think, out of balance a bit. I'm passionate about bringing, I think, what has been the illiquidity premium to the mass investor, because we have seen a fundamental shift that I don't think reverses even in stress times like this, where there are less companies going public, banks are lending less, they're preserving their capital for their best clients, and so you have this real proliferation in the private markets, and I think anybody providing investment solutions has to incorporate both the private and the public.
Yeah, I think that the risk is different in the private markets. We've seen a fundamental shift in the economy, right? I mean, these are not new asset classes. These are asset classes that used to be done by banks and by consumer finance companies that now aren't putting money out. We've just released a report, which you can get on pgim.com, that really shows the magnitude of the shift in the US and the UK of how the economy is being funded. But these are, as Jenny said, often in permanent capital or even long liquidity vehicles. Yep. So I don't worry about liquidity. What I do worry, though, is that at some point as we go into a recession, that poor underwriting on the behalf of some groups within this will actually lead to losses. And you are going to see a bit of a separation from the people who've been doing this for a long time and through cycles, and some of the people who've just started more recently, for sure.
Do you think, David, though, that we are... what I'm trying to understand is also the bigger picture in terms of the volatility that we could see around all of this. We're going to see a slower economy. You've laid that out. We're going to see potentially more volatility as we migrate to an environment where central banks don't have the markets back in the way that they had in the past and have suppressed volatility. In that kind of environment, do you think we're going to see lower AUMs? Do you think assets under management will come down in that environment and will ultimately be lower as we deal with this new paradigm, this more volatile environment, this more difficult to navigate environment?
So maybe over the short term, I mean, one of the amazing things about, we have the fourth largest fixed income business in the world. And, that's very painful when you go through a period of rapidly rising rates. But a large fixed income business is actually much more valuable at a higher level of rates than it was before. And so actually we're moving into a period now where public fixed income and indeed public and private fixed income is actually starting to look much more attractive than it has over the last 5 or 6 years. So short term, yes. Long term, no.
And I'll just add, because you asked that question around the private markets. Again, in times like this, in times of stress, people pull and have to sell from their liquid pools, even if they're not comfortable with the price. And so you don't get the same kind of price volatility in the private markets that you do in the public markets.
Do you guys think there's any chance that we'll see, though, the need to sell in the private market, in the illiquid investments? Like, do you guys think it'll get that bad where that would happen, Jenny?
So we just acquired a company, Lexington Partners, that is a secondary private equity manager. And what happens is, because you need to pull your liquidity from your liquid assets, suddenly pension funds and institutions find themselves overexposed to private markets. And that's where a secondary manager comes in. And they will get a phone call that says, hey, at the end of this is an actual case, at the end of this quarter, we need $1 billion off of our private markets. Can you come in and buy? They come in and buy at a discount, and they're able to cherry pick which managers are going to put into that pool. So I think that, yes, you will see that, because the fact that the prices have dropped in the public market, and it's their source of liquidity.
I don't think that's so much a situation of liquidity. And I completely agree on secondaries, and I think it's a really great business. And we have real high hopes for our secondaries offerings. But mostly this is because of reallocations that institutional investors are doing. They want to keep putting more money out to alternatives, but they already have a lot of proportion tied up. So in order to free up capacity, what they're doing is looking for more secondaries, and then they're able to recommit to new funds as they come up.